Welcome everybody to a brand new episode of Bearish or Bullish. I'm Julie Alexandria here with JC Peretz. JC, I got so bullish last week. I took off, I went to Mexico, I laid out on a beach for 5 days. And what happens? I get back here to the States. My overall investments were down, 10 to 12%. Elon kills coin on SNL. Tech stocks take a hit. And apparently there is a gas shortage on the East Coast. What gives? What happened this week?
It's great. Growth stocks got hurt again. Technology down again. Discretionary's down again. Meanwhile, financials new all-time highs, but we didn't see it in industrials. We didn't see it in energy. We didn't see it in value as a group. For me, stock market's under pressure. I think it's going to continue to be. You're not seeing it just in the S&P 500 and some of the more value-oriented indexes, but you're seeing the pain underneath the surface in small caps, in growth stocks, in tech. You're certainly seeing it in emerging markets. So there's pressure underneath the surface, and I think it's here to continue, most likely getting worse. So if you're in any of those spaces, I think the risk continues to be to the downside or sideways and choppy. Either way, not the kind of stuff that I like to be in.
Okay, well, that goes to my next question, which is going back to last week. You were very bearish on Nasdaq, and now over 40% of Nasdaq stocks are down over 30% from their highs, and it looks like you were right on that one. It sounds like from what you just said, you're looking to continue. Even considering a bounce, still bearish on that one?
Yeah, listen, you're going to get bounces. Like that, I can tell you for sure. No matter how bad things get, you're still going to get bounces. And then we have to think about what we want to do in those bounces. So if we had exposure there, we would want to be taking exposure off, right? We'd be fading that rally. We would be feeding the narrative, so to speak, right? Like the buy the dip in growth stocks, that's the narrative. So you want to feed into that, feed the ducks. Like if I were in a position, if I were a financial advisor, or I were an investor that was still loaded up on all that stuff, I'd be feeding the ducks, feed the narrative. And then at the same time, on any weakness, we'd be using that as opportunity to load up on more value, right? So we're looking at it in both directions, but the weight of the evidence continues to point to buying weakness in the value areas, financials, industrials, transportation, energy. That's where we want to focus our attention, but that's bigger picture. In the near term to intermediate term, chop, chop, chop. That's what we're looking for. I think base metals have extended themselves. Lumber has extended itself. A breather there, like we're already seeing in many stocks and sectors, makes perfect sense to me. And that's what we're expecting. Stay defensive is really the theme.
Yeah, let's talk about that, because in one of your latest blog posts, you were very, very bullish, as you just mentioned, on the value areas of the market, neutral, natural resources and materials. Let's talk about wood for a minute, though. I love this meme, which is true. I guess money does grow on trees. Does any of that surprise you at all?
Well, it's funny because all these memes and like all the inflation magazine covers and newspapers, like everybody, I talk to people that are not market participants. They're like, hey, JC, that inflation, huh? So word's gotten out. And in my experience, when that's the case, take the other side, feed the narrative. And the narrative, by doing that, I think taking the other side is to buy bonds. So I think that continues to be the trade, buy bonds and gold for that matter. Gold being an inflation hedge, I don't buy any of that stuff. I like buying gold when it's going up. It's been going up. That trade's working for us. We want to continue with that. And while bonds have been shaky, they've been trying to figure themselves out. We've had a bullish bias towards bonds. And I got to tell you, the data coming in supports that bullish bias, doesn't diverge from it. So as data comes in, it confirms that we should be looking at the bond market, continuing to look at the gold market, and just stay defensive. Higher cash positions, alternative assets. We talk about crypto here all the time. Those things continue to work. So until that stops, we want to keep focusing in on those areas. Buy what's working and fade what's not. And I think you fade stocks, you buy bonds, you buy gold. That's what we're doing.
And stay defensive. That's the key to gold, right?
Sometimes yes, sometimes no. Look at 2016 when the market bottomed. Gold bottomed also, and gold miners bottomed, and they ripped. So sometimes gold and stocks could have a positive correlation, with risk. It depends on the environment. Sometimes it's more inverse. Many times there's no relationship whatsoever, right? So I think, and I've been guilty of this myself, is overthinking the intermarket relationships when that's not really necessary. Just shut up and just trade what's in front of you, right? When you look at gold, long-term uptrend, healthy pullback, now breaking out again, all of those trades are working. And then in terms of bonds, very similar, pulling back to a very logical area where they should start doing well. And then the intermarket relationships are pointing to the same thing, So I think you buy bonds. So the trade is IEF. That is the 7 to 10 year US Treasury bond ETF. So basically like the benchmark, and 114 is the level. It's that simple. So if you're below 114 in IEF, you leave it alone, right? Leave it alone, somebody else's problem. Above 114, you stay long all day. I like to trade.
Don't make it complicated. All right, well, the latest 2 to 100 Club list is out, and this time you're highlighting various fintech ETFs. Any particular ones you're really bullish on?
I think this is really interesting because this is a scan that is specifically focused on growth stocks, which is the exact area that we want to avoid and sort of fade strength. Now, let me just be clear about that. That's from an institutional money flow standpoint. It's going to be much easier to find individual value stocks to make money from than it is in the growth stocks. In the same way that over the last few years, as growth stocks did so well, there were value stocks that also did well in that environment. But we would all agree it was way easier to find them in the growth space, right? It's just what it is. Now, I think it's the opposite. That doesn't mean that there won't be stocks in growth that do well. In fact, I could virtually guarantee that there'll be some that do well and some do really, really well. So while these areas are under pressure, we want to observe and see which ones are holding up the best, which ones keep pushing up against highs and not just being susceptible to all of the selling that's taking place elsewhere. So we're really open-minded. We showed a couple of, you guys could show up now on the screen here so you could see it. There were a few names that stand out that still are pushing up against those highs. And then when the selling pressure ultimately lets up, who do you think are going to be the first ones to fly away and break out, right? The ones showing relative strength. So if you look here on this scan, there's a bunch of them, particularly the ones that have the closest proximity to new highs. That's sort of how we sort them.
And you want to get in on them early. That's why we have the 2 to 100 Club. All right, the city of Oakland, California is balking at the prospect of a $12 billion redevelopment project, prompting the Oakland A's to look elsewhere. JC, in your opinion, is there any city in the U.S. that could use a baseball team?
Oh, man, you know what a bummer that would be? I mean, I lived in Sonoma for a long time, so I would go down. You could sit like second row at an A's game for like $20. It was awesome. Listen, Oakland already lost the Raiders to Las Vegas. They lost the Warriors to San Francisco. Man, they're going to lose the A's too. I got no beef. I like Oakland. I've had good times there. So we used to go to Cal games all the time in Berkeley. So, that whole area, I love it. I hate to see them go.
Yeah. I mean, it would definitely be a bummer. But the Coliseum was built in 1966.
That thing's a disaster.
It's terrible.
It's nice to watch a baseball game. The place is a dump.
All right, riddle me this. I have a little quiz for you. The biggest country to export, the biggest exporter to China in wine, the number 1 country is France. Riddle me this, JC. What's the number 2 country?
I'd say either U.S. or Italy.
Incorrect. You want to try again?
Spain?
Incorrect. You want to try again?
Germany?
Incorrect. You want to try again?
Oh, it's Australia, isn't it?
Incorrect. But
What?
it is because of Australia and the fact that their trade talks have been so soured that they have been kicked out of their number 2 spot, and Chile has come up as the number 2 exporter to China for wine.
About that. Chilean wine is beautiful. It's great. Listen, you should drink some. It's fantastic.
I'm all about it. And number 3, you want to take a guess what number 3?
Is it Argentina?
It's Spain.
Oh, okay.
You just got schooled. Well, thanks so much for watching.
I like learning this. It's great.
If you want to learn more about wine exports to China or any of these topics, check out allstarcharts.com.
Just because all these cryptos keep breaking out of bases, all of them except for Bitcoin's the only one that sucks. So as it turns out, Bitcoin's a lot like gold. It just underperforms all the time. Turns out it's gold after all.